So, once again, everyone, good evening and thank you so much for your patience. I see a lot of people have already joined, so we'll start the session now. As I was talking about value investing, this is when I will start discussing about this. You will see that a lot of you have already done value investing, but it's a term which always gets us, and we need to understand that what does it mean, how it is different from um, growth stocks, or how value stocks are different from growth stocks. But most importantly, we need to know that how we can invest into value based stocks and what value investing actually is. Now, when we talk about value investing as a concept, we have always invested in some stocks. Sometimes we feel that this company is really good and we should invest into this particular stock, but we always get distracted by what other people are telling us. So today I'm going to tell you how to pick out these stocks. At the same time, I'll give you a few companies which, as per the current analysis, seem to be a good idea to invest in. But again, whatever we are going to discuss today is going to be more for the information purposes. If you want to invest, I would always suggest that take the help of an investment consultant, and always make sure that you have a consultant by you who can advise you, or basically who can give you an opinion about the markets and how to invest into financial markets and which stocks to pick in. As I was saying, when we talk about value investing, it's basically a practice of purchasing stocks that though, and these are those companies which are, or those stocks that are trading for less than their intrinsic value. And this is very important, guys. There have been books written on value investing. As you can see, books by Benjamin Graham, books by David Dodd. In fact, Warren Buffett is known for value investing. Before I get into the concept, to make it very easy for you, sometimes you find these businesses which you feel are really strong, and they have existed for a longer period of time and they're well established, something like Coca-Cola, for example. And then you wait for the prices of these stocks to come down at a point where you feel that below this it cannot go. There, that value at which, below which the stock price cannot go, that value is basically the intrinsic value. So you try to understand how undervalued this company is, and then you buy. And these kind of companies, again, there are companies which are, um, uh, when the prices fall, they reach to that point where they are at the lowest, but this could be a temporary low, right? And it could recover and can bring a gain to your portfolio. So if you were to describe value investing in a more casual manner, that basically means you're buying stocks which are available on discount, right? Or buying stocks on a sale. That is what value investing basically is. And obviously there are few assumptions which are always talked about when we talk about strategies and how do we invest. We always know that good companies, they always prove their worth to the market, right? That is one of the important assumption you have to go with, because when you are going to buy a lot of these companies, you are going to buy them not only because they are on sale, but also you believe that their businesses are really good and it is expected to flourish in the future, right? So there are a lot of these value investing strategies which we look into, and there are some principles also. So first, to understand, so as I said, that value investing means buying stocks which are on sale or available on a discount. How it is different, how value stocks are different from any other stocks. Value stocks are not growth stocks. So always remember this, growth stocks are mostly the tech companies. So any stock which is a tech company is basically not a value company, right? And that is why it is important that we must understand the difference between value stocks and growth stocks. Growth stocks are basically, they come, tech, biotech, these kind of companies, they come into growth categories, while consumer utility, the area of consumer utility or defensive sector, when I say defensive, does not mean arms and ammunitions. Defensive basically means those companies which are expected to retain their value during recession. So to give you an example, if recession comes, you may not buy an iPhone, but you're still going to buy a toothbrush, or you're still going to buy um, food or vegetables. So that is called consumer utility. You're still going to pay Diva bill. You're still going to drive across Salik. These are utility companies, right? So a lot of value stocks are utility stocks, and value investing basically means buying these utility stocks when they are on sale. Now, when I tell you clearly, I'm sure all of you understand that at some point of time, all of you have purchased these kind of stocks. You just didn't know what it was. So this is what it is. Now, there are few strategies that how you do value investing, and that's really important. First strategy when you're doing value investing is called fundamental analysis. Value investors, they always use fundamental analysis to understand that what is the company's intrinsic value. Intrinsic value, as I said, the value below which the stock price is not expected to go. Okay. Now, this fundamental analysis, it can take different forms, but mostly I'll tell you how do you normally do fundamental analysis of a company. You look at their income statement, right? You look at their competitors' balance sheet, you look their balance sheet, do a comparative analysis of how much free cash flow, what is the income statement like, what's the balance sheet like. Now, if you're looking at income statement, for example, as a value investor, you want to see that what has been a history of operating profits, right? What is their core business activity? How much earnings are being generated from their core business activities, right? Operating profit, when we talk about it, measures how effective the business model actually is without interest income or interest expenses, right? If most of the businesses, they take loans, they have to pay interest. So when you're looking at operating profit, you are looking at the effectiveness of the business model, right, without considering the interest income and expense. Now, a lot of times it happens, we compare income statements. We also, if operating profit margins are higher as per the more than the competitors, that means that efficiency of the profit is higher and it can be an advantage to invest in a stock. So if you were comparing McDonald's versus KFC, if the operating profit margin is higher in McDonald's, so that is a plus for McDonald's. Similarly, when you're looking at balance sheets, for example, now balance sheet shows stability, right? But within balance sheet, the value investors need to assess that what is the working capital ratio like. Does this company have enough money to run its day-to-day operations, which is called working capital, right? And then again, what is the debt to equity ratio? How much is the owner's capital? How much is the loan which this company has taken? Then there is something called free cash flows, and there are other valuation metrics also. There is a PE ratio, there is a price to book ratio, and obviously there are these financial metrics which you must study before you invest in a stock. So value investment, uh, uh, somebody just asked a question, that is technical analysis not a part of value investing? See, it is one of the principles, but it comes at the bottom. Your primary focus is on doing fundamental analysis, because when you are doing value investing, you are most likely buying a stock for next 5 or 10 years, hoping that this would become of value. Now, when you're buying something for next 5, 10 years, you want to make sure that the foundation of that business is strong. And that is why you do fundamental analysis, because fundamental analysis requires you as a value investor to go through the income statement, to go through the balance sheet, to go through the price earnings ratios and other financial metrics which are really important for you to study. Please understand this. You as an investor obviously may not have the time or the right amount of understanding that how to study this, and that is why your investment consultants, they do it for you. That is the reason why it is important to have a consultant who can do a thorough research on companies and tell you, that's it, if you were, because you're not just looking at the financials of one company. If you want to decide that should I invest invest in Uber or not, you need to compare Uber and Lyft both. If you are deciding should I invest into McDonald's or not, you need to compare McDonald's and Burger King and two different stocks or not. So you are not just investing into one company. I mean, you may be investing into one company, but to invest in that company, you also need to see, is that the best in that industry, for which you need to do a competitor analysis of their financials, and that's why the consultants, they are there. Next is quality investing. Quality investing is also really important. Why? Because quality investing is focusing on those companies which have conservative balance sheets. Conservative balance sheets, which means the leadership is very experienced, they have a proven track record, their cash flows have grown over the past. The long term success of the company, they have a certain amount of advantage, they have the capacity, their profit margins is high, they have certain amount of niche, their brand reputation is amazing, it cannot be moved. This is also what we call as blue chip companies, right? A lot of these blue chip companies which have an unshakable brand reputation, and they have really good dividends also, they have are very good payers of dividend. Energy companies like ExxonMobil or Chevron, they are good payers of dividend, and they are energy stocks, and that is also a very good value stock to invest in. Let's say looking at quality focused investors. Now, quality stocks, uh, their growth potential is less compared to smaller organizations, right? Because when you're looking at a smaller company, you know that this company is going to work hard eventually. If their business model is good, and if the corporate leadership is good, you always expect a smaller company to grow in size, and that growth can be exponential. But the company which has already grown, already established, their growth potential is less when we compare it to these younger organizations, right? So a lot of times investor can overlook them because they want more excitement in their portfolio. That can lead to undervaluation, right? So a lot of times it happens that these quality stocks, these matured companies, they get overlooked. Like for example, a stock like Ford, just $10 right now. Now maybe it moves $1 or $2 every day. So maybe you are not buying that stock in your portfolio because you need to see a little more excitement in your portfolio. You need a stock which moves like 5, 10, 15, $20, right? Because you want more excitement. So sometimes this kind of stock might get overlooked, and that's why people are not buying it, and that's why the price is coming down. So it's undervalued. It's not undervalued because of their revenue, it's not undervalued because of their business model. It's just undervalued because people are not looking at it, and they are not looking at it could be due to several reasons, right? So quality investing is very important. This is one of the investment strategies, that you pick quality. So one was fundamental analysis, where you do a proper research on the fundamentals. Second, you pick out a stock on the basis of the quality, the one which are blue chips, like Pfizer, for example. These are the companies which have a proven track record. Their reputation is unshakable. They have proved their mettle, and we are talking about the quality names, right? Now we move on. Contrarian investing and dividend investing. These two are also forms of value investing strategies. Contrarian investing is something going against the grain. When you are buying, so you're buying when others are selling, you are selling when others are buying. So it's called contra investing, or investing opposite to what the trend is. So you are buying when others are selling, and when others are buying, you are selling. Warren Buffett, who is a very famous value investor, Warren Buffett used to describe the contrarian approach in a way. He used to say that we simply attempt to be fearful when others are greedy, and to be greedy when others are fearful. So this happens. Like while when others are greedy, we are a bit scared. But when others are scared, we are greedy. This is what contrarian investing is. So this can also be described to that, when when everybody's running towards a stock, that's when you should start walking away from that company. Or when nobody's running towards a stock, that's where you should start moving towards that company. So this is called contrarian investing. Even the hedge fund manager, Bill Ackman, uh, he made more than $1 billion with this contrarian investing, by the way. And this was in early 2000, because he saw too much risk in a bond insurance company, right? And in 2002, he started investing in the company's failure by started shorting that stock, and he leveraged it by shorting that stock, and that stock crashed in 2007. And in 2009, Bill Ackman disclosed that he closed out his position with a profit of $1.4 billion. Imagine $1.4 billion just by shorting the stock, and he went against the trend. So these kind of experiences that demonstrates that you can be profitable by just betting against the masses. But then this requires a lot of patience. You need to identify the trend, you need to understand the investment community, right? You need to understand that there has to be a viewpoint, basically, right? So this is one part. This is where we talk about contrarian investing, right? This is also something which is very important, guys, and this is a very proven strategy. So you can read more about contrarian investing and that style of how people have made money by shorting stocks when people were just blindly flocking into it, and when nobody is buying a certain stock, why you are looking forward to buy it. So sometimes stocks which are less volatile, they just get ignored because they are not exciting enough, they don't move enough, but that does not mean that they are bad companies, right? So contrary investing, again, one of the most important things, followed by strategy number 4, that is dividend investing. Now the quality, if we talk about the best dividend stocks, it overlaps with the qualities of a strong value stocks. So obviously there are companies which have a proven business model, their cash flow is very good, leadership of that particular company is dedicated to reward the shareholders for the risk which they have taken and for the trust they have shown. So there are a lot of these companies which give really good dividends, and they have a decade long history of increasing dividends. So there is a term for this. They are called dividend kings. And there are these companies which are dividend kings. And this is something which a lot of times uh, we see that there are some companies which are dividend kings. They earned this title of dividend kings by raising dividend payouts annually and almost for 50 years. So imagine there are companies which have existed for around 50 years, and they have a history of raising dividends year on year, and that's why they are called these dividend king companies, right? And that's an accomplishment which cannot be achieved without a business that consistently produces rising cash flow, right? So again, that is also something which is really important, right? Imagine there is a company which has continued to increase dividends for 40 years, 50 years, and you are not just paying dividends out of the reserve cash, you are paying dividends because you are making profits, right? For how long you are going to pay dividend if you don't have the profits? So if I were to talk about longest running dividend kings, there's Procter and Gamble. I'm talking the names which you could have heard, and these are also called dividend aristocrats. Procter and Gamble, for 67 years, they have continued to give longest running dividends. There is American States Water, for 69 years, they have continued to give good dividends. Emerson Electric is one of those companies. So again, if we talk about dividend king companies in 2024, there are a lot of these companies, but if of course the industries are mostly consumer utility, like there's a company called Altria, but the industry is tobacco. So for those investors who like to follow Sharia compliance, obviously tobacco is not the industry you want to invest in. For other investors who are looking for a borderline safe and a good dividend yield company, Altria is one of those companies. Gas utility companies like Northwest Natural, or packaged food companies like Hormel Foods. These kind of companies, they have a history of continuing their dividends for the longest period of time. And there are a lot of these sectors. So if you talk about consumer staples, the best dividend giving companies, Coca-Cola is there, Procter Gamble is there, Pepsi is there, Walmart is there, right? And these are the names, again, these are the quality names also. If you look at some companies which are related to consumer discretionary, then we are looking at Target company. If you look at utility based companies, we are looking at American States Water, as I talked about, or National Fuel Gas, for example. Similarly, if you're looking at healthcare, you must have heard about Johnson and Johnson or AbbVie, for example. So these kind of companies, they are big dividend kings. They offer dividends consistently, and you can always look into it. However, obviously not. So this is just one form of investing. So it doesn't mean that a company which is not giving dividend is not a value stock. There are some companies which are good value companies, but they are not able to give dividends because right now their values, the companies are smaller. We are also going to go through some of these companies, but the established names, as I said, Johnson Johnson, Colgate, Procter and Gamble, Walmart, these kind of companies have history of distributing the dividends for years. So if you are following a dividend investing strategy in value investing, you can pick those stocks, is what I mean to say. Right. Please, guys, if you have any questions in your mind, do ask, and continue to write if you have any doubts or any questions, and we'll try to answer your questions while we are doing the session. Now, moving further, what are the principles of value investing? So there are a few principles which you should abide by, and it's always good to follow these principles when you are talking about value investing. Now, if you're doing a fundamental research, obviously you need to analyze the companies. When you're analyzing the companies, you must be analyzing individual companies, but then you're also going to see their qualitative elements, quantitative elements. You are going to do a SWOT analysis, their strengths, weakness. You're going to compare it with their competition. First principle, you're looking for, when you're thinking about value investing, you're looking for those companies which have a lower PE ratio. Lower PE ratio. So when we talk about price to earning ratio, or PE ratio as we call it, PE ratio is calculated by dividing the company's earning per share into the stock price. So you must use, I mean, you can actually use the year before EPS, or whichever the forecasted EPS for the next 12 months. If you use the forecasted EPS, then you are going to calculate a forward PE ratio. But coming to the point, what PE ratio actually tells you is the current cost of each dollar the company earns, right? If the PE ratio is lower compared to the competitor, it indicates that the stock which you're looking at with a lower PE ratio, it is at a bargain, because you are going to be paying less for the same amount of earnings versus the competitor. So when we are looking at a lower price to earning ratio, you're looking at, so it's just a way to see that as per the earnings of the company and the stock price, is it undervalued or overvalued? Lower PE ratio is preferred when it comes to value investing, because that means the company is undervalued, right? Second is low price to cash flow. If the cash flow is stronger, it gives company a lot of financial flexibility. It is as simple as having a good cash flow. If there is a capable management, if management is really good, cash flows are really good, then there is a lot of financial flexibility, and at the same time, these kind of companies could have a very strong earnings, and their foundation can be very strong, and eventually it can lead to higher stock prices. So you need to see a lower price to cash flow ratio, and that is something which indicates that cash flows are very stronger and the financial flexibility is there. Third principle is lower price to book value. If a stock price, or when a stock price is low in comparison to the company's book value, that the sentiment about the company or that particular sector, it is because that maybe the sentiment is negative. Now there could be a potential downside risk. That is the reason why that stock has come down to that point where it is slightly lower as compared to the book value. And that is also it the reason why the stock becomes very attractive also. So somebody just asked right now that what is the book value of a company. uh, Again, we do separate sessions on fundamental analysis, but when you anyways when you're asking about what is the book value per share, so when we talk about book value, you're actually looking at how much money the shareholders have put, right? Because if you need to calculate the book value, you need to understand how much money the shareholders have put against the number of outstanding shares. So that is compared to the current market value, and book value is different, market value is different. In simple terms, if we are talking about a good book value per share, is the one which is slightly above the current stock price. Now that actually means that the company is trading. So if I say that the book value is higher than the market value, this basically means that the company stock is trading below its assets. It would be a good investment opportunity. And when we talk about whether a higher book value is better or not, it is based on the balance sheet. Market value is the total value of the share. So if book value is higher than the market value, that means the stock is undervalued. So if your stock price has fallen below the book value, then it means it's a good point to enter, and that stock is at a discount. So you can definitely look for those kind of stocks which have a lower price to book value ratio. PB ratio or a P ratio, it's not that difficult to find. In fact, that's what your analysts do. See the session I'm conducting for you. Even if you want to do research on your own, you should be independent and capable enough to do this research. That's why I'm telling you, it's not that difficult to find a P ratio. In fact, if you search PB ratio of Walmart, Google right now, you will get something. But you should know that a lower PB ratio is good uh, for investing. If the PB ratio, when I say lower PB ratio, that means that whenever the stock price has gone lower than the price to book value. So if lower PB ratio means that the price of the stock is lower than the book value of the company. That's why we call it a lower price to book value ratio, lower price to cash flow ratio, lower price to earning ratio, that the market value of the company is lower than the earnings. So that means the company is earning more, but the stock price is less, which means it is undervalued for some reason, and there's a possibility it might go up in value. Principle number 4, we look at the value of the company. Now, value of the company means we as investors, we seek to appraise the true intrinsic value. So, what is our goal? Our goal is to make investments which are wise. We want to purchase the stock when they are trading at discount. Now, how they are trading at discount, we need to find the true value. How do we find the true value? There are different methods in terms of accounting to find that what is the intrinsic value of the company. It's a little more calculated, calculative, but I don't want to confuse you at the moment. Just the message is that when you find out using any method that how to find the true value of the company, you need to understand that any price which is close to the intrinsic value is the price which you can buy at. You basically want to purchase a stock when they are at a discount. And how to understand that they are at a discount? By finding out their true value. So if the price is below the true value, you can expect the stock to be undervalued and you can buy that stock. Principle number 5 is about financial soundness. Now, a lot of investors, they prefer the companies with limited long-term debt. The companies with lower debt, they have more flexibility in case of a situation like pandemic, for example, because they have direct cash to operations rather than the interest expenses. Always imagine a company with a higher debt levels will also have a higher interest expense. So if you are looking at a value stock which has lower debt, that should be a preference, that the debt should be lower so that the interest expense is lower in terms of adverse business conditions, in terms of recession. During those times, the company should be able to survive. But if they have higher debts or in a higher interest rate cycle, these companies may not survive. So that is why you need to look at the financial soundness also. Then principle number six is catalyst for recognition. Uh, Consumer or a political or environmental, these kind of impacts, they basically, these kind of trends, they really impact the price of a stock. Now we need to see that, is this particular stock, is there a catalyst of this stock, right? Because if, let's say, I'm looking at a company which is undervalued right now, will it move due to a change in the political situation, or due to change in the environmental situation, or due to change in the consumer behavior? So I need to see some sort of catalyst for this stock to go up, and if we can find that, then that could be your preferred stock. Then followed by next principle, capable management. Again, the management needs to be capable, without saying. Sound business strategies, positive earnings dynamic. When we talk about a sound business strategy, right? A company with a proper business strategy, and they should be able to communicate these strategies to their teams, right? And the leadership should have that conviction, they should have that confidence, they should have that future plan. So these kind of companies, they do really well in the future if they have a sound business strategy. Similarly, if you're looking at positive earnings, for example, earnings, they drive the stock prices higher. So that's why every 3 months there is a earning season, to see that which stock came up with positive earning per share. Those companies that have demonstrated improved earnings and they're expected to go higher, those are the companies which you should prefer, right? And obviously, last but not the least, after fundamentals, we have technicals also. So we have mentioned capable management, but we are putting also technical analysis in this. We need to have a capable management, but at the same time, we need to have a positive technical analysis. We should be able to see the trend, those stocks which are trading within a price range, if they have come out uh, of the downtrend and they are trending higher, so you can pick those stocks also. So these are few principles of value investing, which you can look at. Now coming to the important part, top 10 value stocks which you can buy now. Please understand, while I give you the description about these companies and these stocks, please understand that if you need to build a portfolio, and after you see this session, if you want to buy these stocks, before you do this, please assess your risk. I am giving you an information about this. There is obviously no guarantee or assurance that these stocks will move up. But since we are talking about the value investments, it would not be a worthwhile session if I would not bring these kind of companies into your attention. You can do your further research and take more opinions from your consultants before you invest in it. This is just an idea and understanding of which are these value stocks and why you could buy these companies at the moment. So it's something which is a part of the research, and you can always look into it. First company we are talking about is Kraft Heinz. I'm sure a lot of you already know. Kraft Heinz has fallen deep into the value stock territory in recent years. And this is a company which has struggled also. From 2015, there was a Kraft and Heinz merger. There was a lot of heavy debt load which was taken onto that fund, and the deal that has left the company struggling to find a new direction. Company eventually they reduced their dividends in 2019. Finally, they have now moving and refocusing on its operations. So they had been troubled for a longer period of time. That is why the stock price has fallen down. So if you see Kraft Heinz right now, the price is $35. But if you see the 52-week range, it has been between $30 to $38. But look at the dividend yield right there. The dividend yield is around 4.5%, and that's a good dividend yield for that stock, right? So it's a fixed income stock for you, and at the same time, it's a less volatile stock. Market cap is around $42 billion. So this is one of those companies, guys, which you can look into. See, after 2015, 2019, when they have tried to cut down the dividends a little, they're refocusing on its operations because the Kraft and Heinz merger had a lot of struggle, and there was a lot of heavy debt load which was taken to fund this deal, and that is the reason why the Kraft Heinz company, it was left struggling to find a new direction. Now, after they slashed dividends and they have started refocusing on the operations, these kind of efforts now, they appear to be paying off. Their earning per share have actually gone up from 2019. If you compare 2023, in 4 years, their earning per share has increased. Even this year, a lot of analysts have estimated their earning per share will increase further. And P ratio is around 11, which is good. Earning growth, if you see, it's very impressive given the kind of struggles this company had, because pandemic was a very worse year for a lot of consumer staple companies also, right? And additionally, Warren Buffett's company, which is Berkshire Hathaway, this company owns more than a quarter of Kraft Heinz outstanding stock. So this is also one of the very important points, guys. Warren Buffett's company, which is Berkshire Hathaway, it owns more than a quarter of this outstanding stock. So now, maybe 4 or 5 years earlier, I could not have said for this stock, but now the way they have progressed in last 4 years, and we are expecting their earnings only to increase further. They have kind of refocused their operations, and again, a major chunk of the stocks have been purchased by Warren Buffett's company, which is very impressive given the status of the company a few years ago. So this is one of the reasons that we are vouching for this particular stock. So you can always check. As I said, guys, I'm giving you this information, but you can always go ahead and check. Do your research also. See, right now the stock markets, there appear to be at a very turning point. There was a lot of momentum which was put into AI and semiconductors, which is still there. But eventually, sometimes what happens, AI stocks, tech, people kind of move away from this. A lot of investors now, they are giving a fresh look to the underperforming sectors like consumer staples and utilities. And this is especially happening when Federal Reserve is now in on a journey to cut interest rates. So a lot of people, they want to diversify. Some people want to get away from tech, so they would look into these value stocks also. And that is why let's try to be open for diversification. So this is one of those companies. Next is BCE Inc. And BCE, again, it's a Canadian telecom company. And so we are putting all the sectors into it, right? Right now, you saw this was a food based company. Now we are looking at BCE, which is a Canadian telecom company. This offers TV, wireless, broadband internet connectivity. Right now, this company has more than 10 million customers, right? Which is, if you see the overall Canadian telecom market, it's close to a third of our overall Canadian telecom market. BC stock also has underperformed a lot in last few years, and a lot of investors, they have fretted about the higher cost of deploying 5G networks, and that was the problem. A lot of cost incurred on deploying 5G networks, along with, because interest rates were high of lately. So because interest rates were high plus costs were high, so telecom providers suffered a lot, and this company also did. But now, because a rate cut cycle has started and it is beginning, telecom industry is through the burnt of this 5G expenses. Now they are looking better. And if you see the most impressive thing in this, the numbers, the 52-week range from 31 to 41 dividend yield, if you see, look at the dividend of this company right now, it is 8.34%. Now this is important. Why? Because 8.2% dividend yield, this is very appealing, because if interest rates are being cut, that means People would not buy bonds, because now new bonds people are not buying because the rates are lower, right? And over the next 1 year, if rates cut more, then people would start getting away from bonds, and they will look for companies which are giving at least a good fixed income. And during that time, a stock which is giving 8.2% dividend yield, I mean, investors can easily rotate from fixed income back to these kind of high yielding dividend stocks, right? So, as I said, dividend investing was one of this part of value investing. So that is why, guys, keep a look at this stock is what I'm saying. And let's see that how this works out. Next stock is Endava PLC. It's a British IT consulting company, focuses on UK and European clients, primarily in banking and financial services and payment industries. So this is again one company which we have picked. This mostly when we are looking at Endava PLC at the moment. Here, if you see the numbers, they are not providing any dividends. So dividend yield is very less. But look at the 52-week range. 24.5 the lowest, $81 is the highest. Now this is important. It's just a $1 billion market value company. So it's not a very big company, right? So this is something worth noting. You're looking at a very smaller company. Their share price actually collapsed in last 2 years because it clients have slowed down spending on IT services, because now people have returned to the office. It's not the pandemic era anymore, so demand for digital services have kind of trailed off a little. But now this particular cycle is to be turning. Now Endava as a company, if you see, they have set to resume a double digit top and bottom line growth in 2025. So this is a good stock because, right, if you compare the stock from 2021, it is still down by 80% of their 2021 highs. So in 2021, the price at which it was, right now it is at 80% discount. Okay. And this particular company, it has branched out into other markets in last few years, right? They purchased a company called Galaxy Group, and that company brings them into the healthcare consulting sector also. So that is the reason why we are looking at this stock, in spite of the fact that they are not giving any dividends and smaller company, but just because they are they are available at 80% of their highs from 2021. So keep a check on that stock. You can always note it down, do more research on it if you like to. Next is global payments. Again, as I said, that we are bringing different sectors over here. And if you see global payments, it's a financial services company. It's based focused on payment processing technologies, helps the merchants in all types of transactions. We talk about debit cards, credit cards, checks, contactless payment options. And there is again a lot of competition when it comes to these kind of companies. During pandemic, as I said, there was a lot of push for this company because people would go for contactless payments. So pandemic was a very good time for these kind of companies, and a lot of merchants, they modernize their systems to reduce the cash usage, accept more digital payment options. Now, as an e-commerce momentum, if we see in last few years, it kind of has slowed. Economy has normalized, right? Post 2020, we have seen that people are getting used to now getting out of the house. And again, digitalization is there, but then if we talk about the e-commerce momentum, that has slowed down if we compare to 2020. Now this kind of growth, again, the valuation of the this particular company has also come down. The stock, if you see in particular, it has dropped almost 50% from 2021 peak. Now this is really hard to justify because, again, the company continues to grow. Their revenues are doing really well. The earnings this year have gone really well. So now their PE ratio is still high. And that is the reason why we are still looking at this stock. It's a payment processing company, and their revenues are good, their earnings are good. But if you compare the peak of this stock, which was in 2021, it is almost down by 50%. So these kind of stocks could be a good steal, guys. And that's why, again, dividend yield is not that great, 0.89%. But look at the 52-week range, 91 being the lowest, 141 being the highest. And closed last at $112. Now it is 111. Market cap is around $28 billion. You can always have a look at that, these kind of stocks. Next is Ford. As I said, that Ford is again one of those companies which goes undervalued a lot due to high interest rates. The high interest rates did crush certain parts of the economy. Auto market was one, because if interest rates are high, people would not borrow auto loans or buy cars. Also, the in between, the value of the cars was skyrocketing, and auto market is one such example, uh, which was crushed under a high interest rate environment. Because if you see the new cars and the used cars during the pandemic, there was a boom. Demand has now crashed back. Now, at the moment, auto producers have big inventory gluts. Pricing pressures are a lot. Investors are worried about that if there is a recession in this particular industry. Why this has happened is important. Now, this is very like this particular pain which we are looking at this company. This is also because of the EV segment, right? Now, in case of Ford, they have reported massive losses in the EV operation in the last few quarters. But now interest rates are falling. Now, that should help the new car demand also. And again, there are government efforts to protect the domestic EV industry from the competition. Now, that also can lift profitability on this front as well. So Ford shares are pricing at the moment at the very worst point, but then the recent developments which are happening, take initiatives by the government, and then in a lower interest rate environment which starts now, and maybe in the next year the rates are cut more, that could push the price higher. That is why this is the appropriate time to look into this stock at the moment. And if you see the numbers, it has a 5.5% dividend yield, so it's a good dividend stock. 52-week range is $9 to $14, so it does not move. It's not too much volatile also. Plus, the company is a $42 billion worth company. So you're looking at a stock which is less volatile, giving you a good dividend, a fixed income, and it's a $42 billion worth company. And with a lower interest rate environment or a rate cut cycle beginning, it could stimulate more automotive demand, and that could bring the stock prices higher. Now we move on to another company which is called Adient PLC. Around 70,000 employees, major player in the automotive parts and material space, right? Focusing on seating systems and components. Automotive space, as we just talked, there was a slowdown and a crushing impact on the sentiment for the vehicle component makers. Stock is now down about 50% over the past year, right? So 50% over the past year, and that's really crushing, right? So we need to also understand it's a smaller company, $1.94 billion. The fall, however, looks like a very overreaction, because analysts are projecting only a 5% decline in the revenues in 2024 before the company starts returning to the growth next year. So even on this year's down results, this stock is selling for a higher PE ratio, which is good. And a lot of analysts are believing that the stock has at least a fair value of $68. Right now, it is around 26. So a lot of analysts have a target of 65 or 66, and this is something which is important to look at, given the automotive sector is expected to return back. Then comes Albemarle Corp, one of the world's largest lithium producers, and they have operations around North America, Chile, and Australia. It's into a commodity industry, but Albemarle had a very stable, very consistent results over the years. Lithium mining, guys, lithium producers, lithium is used in batteries which are made for electric vehicles. So it has managed to pay increasing dividend for 29 years in a row. So it's one of those dividend like I was talking about dividend kings, right? Or dividend aristocrats. It's one of a very rare dividend aristocrats in a basic material space. So you don't see companies like this. Now, if you see, the current price is 86, but the 52-week range is 71 to 177. So it is down right now, has a dividend yield of 1.8%, is a market cap of $10.2 billion. See, with Albemarle, lithium prices in last one and a half years, lithium prices have collapsed because demand from Chinese EV market has reduced. Now, there was a major news for the lithium market, and that happened, I think, last week. Uh, as per a few financial analysts, the key producer of lithium, which is contemporary Amperex Technologies, they might reduce the output. Now, that could really stabilize the lithium market also, and that should help recovery in this particular stock. The stock is still down 50% over the past year. So it is still available at a good discount. Again, guys, have a look at it. As I said, their dividends have been consistent. It's one of the dividend kings, available at a 50% discount. Given the output of lithium is expected to reduce, that could push the prices of lithium, and then could be a good idea to look into this company. Moving on, JD.com. We all know JD.com. It's again, it's a Chinese e-commerce company. The shares skyrocketed from $30 to $100 between 2019 and 2021, but now the stock is back to the same level where it was during its IPO back in 2014. Now, this has again, if you see, JD is far larger, more profitable than it was a decade ago. And that is really important because now it is back to its IPO price. If you talk about the revenue itself, their revenue grew from around $80 billion in 2019 to $150 billion for 2023. Their revenue is still growing. Analysts are projecting around 167 billion in this year. And even last month, their earnings came really well. They have done a stock buyback program. Now, this is a stock which should not be missed, and it is trading at a good PE ratio. So, guys, have a look at it. Read more about JD.com. I mean, uh, the stock price is down from 100 to 28 again, and this was the same price at which it was launched from on its IPO. So it has a lot of movement. It has a dividend yield of 2.6%. It's a $40 billion worth company, and the company is much more profitable than it used to be a decade ago. Plus, their last earning per share has been really good. Their revenues are coming really well. So keep a check on JD.com, guys. Is what I'm saying. Next is again another Chinese company, Yum China Holdings. JD is not the only stock that has went for a sell-off due to the economic slump in China. There's a fast food restaurant, Yum China, has sold off on these concerns. The company operates KFC, Pizza Hut, and Taco Bell brands in China, along with several other homegrown Chinese restaurant concepts. Now, investors, they dumped this stock because when Chinese markets were uncertain, last 1 or 2 years, we have seen 2021, 2022, Chinese economy was very uncertain. The shares of this company fell down around 50% from its 2023 peak. Their core business is actually performing well, and a lot of analysts are expecting that the revenue growth is going to be there this year. Their sales will be hitting a new record high. Um, right now, again, the important part is that this company's menu which they offer, it's really budget conscious, so that is very appealing for the consumers. And again, look at the company. That's all I'm saying, because I want to lay out the facts. I want to bring these kind of companies into your attention. A lot of people run away from Chinese stocks because of the last 2 3 years, how the markets have performed. But now China is going through a major change. They're injecting more cash in the economy. Their long-term financing rates have reduced. So a lot of these companies which were undervalued for a while, now there is a time that could be pushed higher. So another and the last stock in this portfolio is SiriusXM. It's an audio entertainment company focused on satellite radio, and the company's shares have actually gone down for a while. There was a buyout speculation, but it did not happen, and that was the reason why the stock fell down. Now there's a new dawn for this company. I think on 10th of September, they did a complete restructuring transaction, and that is making shares look more attractive for the investors. The valuations fundamentally are more improved. Um, the media company which they had. So they're merging the Liberty Media stock with Sirius XM. Now, in this case, they might also go for a reverse split, and they might buy some shares back. So there is a lot of restructuring going on in the company. I want to talk about the restructuring bit. Sometimes when the companies are going through a very tough phase, a restructuring in the capital structure is actually a good news, because that means the company is working towards to get their stuff together. And that is the reason that if you see the 52-week range, the stock high is 57, the lowest is 22.8. Dividend is 4.5%. So it's a good dividend based company. It is available at a cheaper price. It is working on a strong, making their financials more strong. So again, could be a part of your portfolio. Right, guys. So this is what value investing is. Obviously, for a successful value investor, a few tips which I would definitely want to give it is that you should invest in a company which have the margin of safety. Margin of safety means the difference between the stock price and the intrinsic value, as I said. Larger the margin of safety, more protection you have against being wrong in your own assessment, right? So this is really important. You should always keep your portfolio diversified. Does not mean that, so don't just buy all the food package companies. You could, like, the portfolio which I've shown you, it's very diverse. So audio entertainment, you're talking about a automotive company, you're talking about a digital payments company, you're talking about a food package company, like a diversification. Plus, for value stocks, you really need to have that patience, and you have to focus on the long term. Warren Buffett made so much money from Coca-Cola for years and years. He had continued to hold on to that company. You need to have patience for this. Plus, avoid making emotional decisions. I mean, that is there for every investment. You should definitely not um, do any emotional based investing. But yeah, I think this is something which you should employ in your portfolio. So I'm sure that a lot of you invest in tech stocks. While you're investing in your tech companies, value could be your thing. It's a fixed income stock. It gives you some dividends. It doesn't move too much. So it brings that stability in your portfolio. So that's what I want to talk about today, guys. Thank you so much for your time. As I said, that it's always a pleasure to come every night, 7 to 8, and sit with you and discuss about different things. I think this has been one of those months where every single day we have come up with a new topic. We started with financial literacy. We talked about fundamental analysis, economic data, options trading, European Central Bank decisions, ETFs, value investing. Yesterday we talked about bond investing. Today we are talking about value investing. Monday we are going to discuss about advanced technical session, and then the next coming week we'll be talking a lot about US elections and their impact on your portfolio. We are going to discuss a lot more about topics which are connected to what is going to be the Chinese market outlook like, what sort of strategies you can do. So follow century.ae, go into webinars, register for these topics. And I hope to see you on Monday, 7 to 8, on a different topic. If you like this session, ladies and gentlemen, you can go to Google Reviews, Century Financial, and please do give your feedback. This really helps us and keeps us motivated to do these sessions more and more. As I said, that the stocks which I just told about, just have a look at them. Do your own research, of course. This is mostly for information purposes to you. But there are so many stocks which you can invest in, and there are so many value stocks which you can look at. And I have one more portfolio about real estate investment trust also. Really quickly, just to share it with you, this is something which we have been actively working at. If you want to, have a look at it, and these are real estate investment trust. Recently, because as we have seen that uh, of lately rates are being cut, so that could make real estate one of the important areas of investment. Now, you don't have to always buy a property to invest in real estate. You can actually and very easily own a piece of real estate through ETFs. So that is also something which can be done. Just let me check if I can. share that right away. Yeah, and here it is. So this is one of the portfolios, guys, which we have recently prepared, and this is about the real estate investment trust. And as I said, that mortgage real estate investment trust, they stand to benefit from a rate cut cycle which has started, because mortgage rates now will start lowering. That will boost the real estate demand. And obviously, the long-term bond yields have now started coming down after the rate cut. So this will also impact the mortgage rates as well, and it is expected that it might come down also. There are few real estate trusts which you could look into. These are the few names which I'm giving it to you. AGNC Investment Corp, Armor Residential, Dynex Capital, Ellington Credit. And if you see their potential price appreciation, uh, the second last and the last, Dynex and Ellington, the expected potential price appreciation is around 7%, 4%. Obviously, not much volatility in these companies, but then a lot of these companies have declared good earnings report. The improvement in their net interest expenses have been better. And as we see that these are the kind of stocks which you can diversify with, but these are real estate investment trusts. This will help you to take exposure in real estates, and you can definitely have a look at it. If you need a copy of this portfolio, you can definitely ask us, and if you need to have a one-on-one session, we can definitely sit with you and explain this to you. Right. So I hope that you noted down the stocks we talked about, and I'm sure you're going to keep a track on it. Please talk to your risk experts if you need to invest in either one of them. And till then, I hope to see you guys on Monday, 7 to 8 p.m. And let's foster a culture of learning and uh, understanding new concepts and being aware of financial and investment opportunities, and making sure that you can independently take your investment decisions. So, with this note, I end today's session. You have a great night. You have a great weekend. I hope that everybody enjoys the next 2 days, and you're back with the same velocity. You are back with the same vigor. You are back with the same enthusiasm and excitement on Monday. And we are going to discuss more about financial markets. It's going to be a power packed week next week. And let's hope to make the best out of it. My name is Yogesh. Once again, thank you so much for your time, and I'll see you next week.